Meena Flynn is with us, co-head of Global Private Wealth Management at Goldman Sachs here at Bloomberg Invest. Hello, hello. You've been very patient. There's a lot coming at investors today. How do you make sense of this environment?
I think the number one thing that we have to remember is that when it comes to individuals, the first thing you focus on is portfolio construction. Portfolio construction drives 90% of a client's returns. And it's something that we talk about upfront and then on an ongoing basis with them. And the reason why this is so important is in times of volatility, such as we've had this week and that we've had today. And what you don't want is you don't want investors to be taking so much risk that they become uncomfortable and they sell, they crystallize a loss versus staying put or buying. But on the flip side, we want to make sure that we encourage clients to take enough risk so that they offset inflation on an after-tax, after-spending basis. So our portfolios are really constructed with investment-grade, high-quality fixed income, and then a good amount of equities and alternatives.
Let's talk about the equities first. In terms of geographic exposure for those equities, what has it traditionally been? And look, we know it's not a monolith. Every client is certainly different. But in general, how do you think about U.S. equities versus equities outside of the U.S.?
Sure. So we prefer U.S. equities, and we prefer that both in both public markets as well as private markets. Big picture, we have roughly about a 40% allocation to public equities. The largest allocation of that is to U.S. equities. And then outside of that, developed international equities. We do have a small percentage to emerging markets. But then also, I would say we have recently increased our allocation to private markets and to private equity, and specifically as it relates to buyout and growth. And the reason why is because these are two subsectors of alternatives where you see a significant amount of alpha relative to public markets, and also the distributions of returns is much more narrow than other sub-asset classes within alternatives.
In terms of private equity, are you upbeat about the ability to start seeing exits, which is something that has been really difficult over the last few years?
It has been difficult as it relates to public markets. I'm upbeat as it relates to private equity on two things. One is I do think to the extent that you have opportunities right now in public markets to be able to take companies private, I think that's an attractive opportunity for private equity companies. Second, I do think that there's a lot of opportunities for private equity companies in the private markets. So they don't necessarily have to only think about taking a company public or M&A as their only alternative to liquidity. So a lot of secondary private equity funds, a lot of continuation funds. The other thing I would note, although, is if you look at growth valuations in private equity, what you have seen is you have seen a normalization of valuations between public and private markets. And the reason why is because you've had really strong performance with these portfolio companies, and it's allowed these companies to grow into the target exit valuations that these GPs were looking for. So I do think once you have a little bit more stabilization in the markets, you're going to see more deal activity, both as it relates to IPO as well as M&A.
Okay, so let's talk about potential stabilization in the markets. Just in the last couple of weeks, we've certainly seen things change quite a bit. As Carol mentioned, at one point today, the S&P 500 had given up all its gains since that November 5th election. Tariff concerns about the economy. What's your outlook?
So I would just, the thing that I'm really thinking about is the sequencing of policies. And so if you look at the Trump administration, it is a pro-business administration. But what we're seeing right now is some of the negative hits to growth come first, whether that's immigration or whether that's tariffs. Before in the second half of the year, we're probably going to see some sort of tax reform as well as deregulation. And so I think what we've got to be mindful of is a little bit of that curve. Generally, the number one driver of U.S. equity returns is a growing economy. Even with the tariff rates that we're talking about right now, we still do anticipate that we're going to have positive GDP in the U.S. And so from here, we still do see equity market upside in the U.S.
So, Meena, you guys don't think about recession because it does feel like all of a sudden the narratives change a little bit. We've seen weaker consumer spending numbers, consumer sentiment numbers, manufacturing data. So no concern. GDP Now data, which we know from the Atlanta Fed, can be very volatile. Recession off the table completely for this year?
It's definitely not off the table. Okay. And we absolutely are looking, at the data, whether that's consumer spending. The jobs report this Friday is going to be important. But you're also looking at a growth of over 2%, 2.5%. And so we have the odds of a recession, even with these tariffs, relatively low, call it 15 to 20%. I do think it's important just to take a step back and just look at, we've got an S&P that's down roughly 1% year to date, right? We've got a lot of volatility, but we've got an S&P that's down 1% year to date. Okay, where you've really seen that underperformance is in the consumer, to the macro points that you were talking about, as well as in technology, just because you've had some of the growth decrease in earnings outperformance versus, call it, the rest of the 493.
Right.
But outside of consumer and technology, all of the other sectors are positive. And so what I'm really focused on is the earnings path for the other 493. I think the Mag 7 is going to be fine, but what we're going to see versus 24 is likely a lot more earnings growth. So call it 3% in 24, roughly 8-9% this year. And so, and just to your point as it relates to tariffs, we anticipate that every 1% increase in the effective tariff rate decreases growth by roughly 10 basis points and increases inflation by 10 basis points. So it is manageable. I mean, it's going to depend on what happens, how long those tariffs are in place, if they're rolling or not. I think if they're rolling tariffs, it's going to be much more hard from an inflation perspective.
Do you think that's up in the air? Based on just kind of the mode that we've gotten from the White House in the last 24, 48 hours, do you think that these are going to be lasting tariffs that stick around for a long time? Will there be more possibly? Or do you think that things could change in a week, in a month?
I think things could absolutely change overnight, in a week, in a month. And I do think that there's going to be incrementally more tariffs that we see on things like autos. And I do think that there's the opportunity to also make a deal with, Mexico, Canada in the near term and actually, have those tariffs reduced. And so I think the ultimate is we don't know what's going to happen. And the main thing we're focused on is that economic data.
Do you think that tariffs on Mexico and Canada are more damaging than tariffs on China? Because it does seem like the Mexico and Canada tariffs, there is this off-ramp when it comes to, what the president and his team have called essentially the border crisis and the drug war.
Yeah, I mean, I think
China, we don't necessarily see that off-ramp.
Yeah, when you look at 25% tariffs that you're talking about with Canada and Mexico, it's much more substantial than the tariffs that you've actually seen on China. And so when you think about that effective tariff rate right now, it's roughly about 8% if things stay as they have been announced. An 8% tariff rate would actually hit growth by roughly, call it, 80 basis points, and would increase inflation by roughly 80 basis points. That being said, we already had inflation coming down from where it is right now. And so we probably get to roughly a 3% level if that's the case. Again, it's not our estimate or our perspective that tariffs stay at these levels. But if that's the case, you still have an opportunity for the Fed to be able to react if you have inflation, even at that 3% level. And so what we saw in 2019 is the Fed cut as an insurance cut. And could we see that again today, or call it May, June, December? Absolutely. And I think the market's pricing more of that today.
That's exactly what traders are pricing in 3 rate cuts. What kind of blows my mind is, though, as you say, things could change quickly, overnight, in a week, in a day. And that's kind of the environment that we've seen. And we've seen it play out in terms of the rate environment. One thing I want to ask you, because I think there's been an assumption when it comes to President Trump, his tolerance of market volatility, that he was watching the equity markets. It was kind of interesting to see, I feel like, over the last few days where the markets certainly the equity markets had some problems. And we just had this assumption that President Trump would do something, say something. I'm curious what's the conversation you guys all have around that?
Yeah, I mean, definitely there was...
Trump put, whatever you want to call it.
Yeah, I mean, there's definitely the perspective that there was going to be a deal done, which is why, the markets are reacting like they are. And you do have a president that has really focused on pro-business policies. But at the end of the day, he's very focused on bringing manufacturing and jobs back to the U.S. And the question is, can we withstand that volatility? Can the consumer withstand that volatility? Can CEOs withstand that volatility and continue to invest in their businesses?
One thing I want to ask you, John Williams is coming up. He's going to talk with our Michael McKee. If you were sitting down with him, or what do you hope that Mike asks him? Because I'm curious. I think Mike probably a week ago had a different set of questions, and he probably does today. But what would you want to hear from John Williams, or what would you want to hear him talk about?
I guess I would want to know, as it relates to on the tenure, what's his thoughts as it relates to the tenure? We have a Treasury Secretary who's suggested that he's watching that, right? And so what is the absolute level of the tenure? Why is it moving? How fast is it moving? And how does that play into their overall picture of kind of risk tolerance, and how does that then affect if they cut rates, they don't cut rates, and do they do that? Can they do that even with inflation? Call it if inflation does tick up to call it 3% or so.
We're going to be hearing from John Williams in just a minute, so we'll see what Mike asks. And before we let you go, Meena, crypto, is it part of the alternatives in a portfolio for your ultra high net worth clients?
It's not part of our clients' portfolios. And the main reason that is because we don't see it as a store of value. It's very hard to actually value.
Oh, please repeat
cryptos.
that for the crypto folks in the back.
Yeah. So
You don't see it as a store of value, is what you said.
we don't see it as store of value, and it's
Okay.
highly volatile asset. And it's hard under what valuation metrics do you actually value it. So no, we don't have it as a part of our core asset allocation.
All right, don't throw anything at Meena, crypto people, when you see her around, because she said what a lot of people think, I think it's fair to say.
Absolutely. Listen, thank you so much. So appreciate it.
Of course.
Meena Flynn, co-head of Global Private Wealth Management at Goldman Sachs here at Bloomberg Invest.